So far, the global stock market is down about $11 trillion. That's trillion with a T. And there are several indications that would suggest that this rout market isn't over yet. And the intent of this video isn't to create some level of incremental panic within the system as it relates to the future of the stock market, but it is to basically provide some level of data points and commentary that would suggest that perhaps investors should proceed with caution. Now, this is very important at this point in time, particularly with the S&P 500 sitting in correction territory, which has a lot of people coming out and suggesting to people that they should buy the dip, i.e. suggesting that perhaps the market has hit its bottoms and it's only going to have an upward trajectory from this point on.
When there were a whole bunch of big rate hikes culminating in a 75 basis point hike. You know what happened in 1994? Here's the chart, courtesy Larry Williams. Remember, he said the rally would start today. Look at this. Turned out to be a pretty darn good buying opportunity, didn't it? It's right here, right there.
So what are these data points? What is some of this incremental commentary? Let's go a little bit further into that as we go through this video. Jamie Dimon has suggested a couple of weeks back that we're at the start of something called an economic hurricane. Now, he's unable to actually quantify the impact of this economic hurricane and has essentially suggested that only after the hurricane has concluded will we be able to tell the impact of this whole thing. Even Elon Musk has suggested that the state of the economy, or the future state of the economy, gives him a very bad feeling. Now, Elon Musk isn't an economist, right? But he does have a pretty good view in terms of how the economy is actually working due to his exposure to things such as supply chain, rising prices, and of course, unemployment as well. Now, the general reasons that were cited by Jamie Dimon in terms of how he views this economic hurricane basically taking place has to do with a lot of the factors that a lot of people have covered in different videos, whether it's fiscal policy or monetary policy, whether it's the impact of supply chain driven by the effects of the virus, or presumably it also has to do with some of the impact of the European war with the Russian incursion over Ukraine. Further, recent inflation numbers, or inflation numbers in general, are doing absolutely nothing to calm the market, and there are several indications that would suggest with the price point that the market currently has through June, the readings for inflation is going to be higher when this month concludes than it was in prior month, where inflation came in at 8.6%.
I'm baffled by people who are confidently saying inflation has peaked. Becky, if you take the first 10 days of June, and if they are what prevails for the whole month, the next measures are going to be even higher. So inflation has not peaked. We need something to happen to stop this inflationary process broadening throughout the economy and building its own momentum.
In fact, for lots of market participants, there's at this stage even a greater distrust in terms of the actions of the Fed, because market participants do actually believe that there is a lack of control when it comes to the Fed as it relates to inflation as a whole. And on top of that, even the Fed chair has come out and said it, right? He's come out and basically said that the Fed has limited control when it comes to supply. But what it can do is control demand. And the Fed is prepared to do whatever it takes at this stage in order to control inflation and bring it down to its desired levels of about 2%. And unfortunately, what that means is in order to control the demand side, you need to take money out of people's pockets. It could mean that there could be a rise in unemployment. And the Fed in the recent press conference even said that they would be comfortable with unemployment rising up to 4.1% conservatively. Lots of market participants and pundits are basically arguing that at the next Fed rate hike, it should be at over 100 basis points, or at least 100 basis points. And there are several that would suggest that even after a 100 basis point increase, it is still going to be insufficient to effectively combat inflation. And this is largely based on historical data. If you look at historical data when it comes to the Fed funds rate, even after a 100 basis point or 1% increase to the Fed funds rate, it is still at historically low levels. The Atlanta Fed publishes something called a GDP Now report, and the intent of this particular report is effectively to forecast the amount of inflation reading that is going to come out when the actual numbers are released in July for Q2. Back in May 24th, so just a few weeks ago, this report was basically suggesting that the amount of growth for Q2 was going to be around 2%. And that number, a couple of weeks later, was basically slashed to 0.9%. Now, when it comes to GDP is simply just a calculation. It's got a certain component of personal consumption. It's got a certain component of business expenditure. It's got a certain component of government expenditure in there as well, and it's also got a factor for net exports by the US as well. Thus far, consumer spending has been relatively strong, except in certain portions of the market, such as the car market, where prices are rapidly declining. The Michigan consumer confidence numbers are also suggesting that some of this level of discomfort that the consumer has at this point in time is quite significant. That's on the consumer side. As it relates to business expenditures and investments, there's lots of indicators that would suggest that businesses are also pulling the foot off the gas, if you will, when it comes to some of their expenditures and investments. There's lots and lots of articles out there that are now talking about rising unemployment and companies basically pursuing a layoff strategy. And as rates continue to increase as well, driven by the Fed funds rate, which we've already talked about, the cost of capital or the borrowing for a lot of these companies is going to be more challenging or more expensive, due to which they will of course invest less. So business expenditure and investments is of course lower than what it has been. And now if we were to start looking at the government side of the house, even government expenditures outside of potentially the war that is effectively taking place and the support that the US is deploying towards Ukraine, which albeit is much needed, would generally suggest that the economy is contracting as well, because government spend is actually lower than what it has been from a rate of change perspective previously. And as I mentioned, there's the fourth component when it comes to the GDP calculation, which is that net exports number. With the dollar basically getting stronger and stronger, the cost of US goods is also getting higher and higher, due to which the amount of demand for US exports is also going to reduce, which is obviously going to have an adverse effect to the economy. So to basically say or to suggest that, hey, the GDP of the US is not contracting even further this quarter, well, it would be very challenging to make an argument that that is not necessarily the case. Then, of course, there's the housing markets, and housing prices has continued to move up due to the whole supply-demand imbalance, which I won't go into a significant amount in this video, but there are some indications that would suggest that even the amount of pressure that is on the housing market is actually going to increase quite a bit. So what does this all mean? Well, we can really four key takeaways when it comes to this whole thing. One, the likelihood of an economic recession, well, that almost is a given at this stage of the game. Two, it certainly would suggest, due to that the stock market has not effectively hit its bottom yet, though that should have a limited impact to a long-term investor. Three, it is very likely that the amount of job losses out there is going to continue to increase. The Fed has held no bars when it comes to this particular fact pattern, and we are seeing it in the economy already. So it is important to effectively hunker down on a personal consumption front. Fourth, the likelihood of a global economic downturn is also pretty much in the cards at this stage, and we've seen other countries raising interest rates. Just last week we saw Switzerland as well as the Bank of England, both of which jacked up their rates as well. There are certainly lots of indications at this point in time of a continued economic downturn than an expansion. The best thing that you can do in this market is obviously to continue to invest at a consistent rate every single month, every single week, whatever it is that you do in order to invest in the stock market, because it is very hard to actually pick the bottom of this market. And if anybody actually claims that they know whether the market has bottomed out or not, does not actually know what it is that they're talking about. But now it's up to you. What do you think is going to be the read for the Q2 GDP number? Do you think it's going to suggest that we are in an economic recession? Include in the comments below. If you've made it this far in the video, don't forget to like and subscribe, and I'll see you in the next one.